Right now, Beyond Meat, ticker BYND, is trading live at $1.13, and it is having an absolutely wild session, up over 12.5% intraday. The market is clearly reacting with extreme volatility, and the volume is simply staggering, already crossing 50 million shares. This isn't a normal day. The immediate expectation when you see a 12% pop on a stock this beaten down, a stock that has fallen from over $200 to barely $1, is that maybe, just maybe, there's good news. Maybe a buyout is coming, or they've finally turned a profit. But the reality of today's move is far more complex and, frankly, more desperate. This isn't a recovery. It's a battlefield. The expectation is that this company is quietly fading into bankruptcy. The reality is that this stock has become a highly volatile trading vehicle, a war between deeply entrenched short sellers and a retail crowd looking for one last squeeze, with today's action looking very much like a short covering rally. Let's establish the common ground, because we all remember the story. When Beyond Meat went public, it wasn't just an IPO, it was a cultural event. This was supposed to be the Tesla stock of food. It captured the imagination, promising to disrupt a multi-trillion-dollar global industry. Investors piled in, believing this was the next great growth story, the next Apple stock or Nvidia stock that would redefine its category. People managing their own online investment accounts and even some Schwab Intelligent portfolios probably had exposure, believing they were buying a piece of the future. The narrative was simple. Meat is old, plant-based is new, and BYND would lead the charge. But the mistake so many investors are making today is still viewing this through that old lens. The challenge is to stop thinking of BYND as a growth company and to see it for what it is, a company in a fight for its very survival, pinned down by a broken balance sheet and a fundamental shift in consumer demand. The story is no longer about growth, it's about cash burn and debt. What we're seeing today isn't a celebration of its fundamentals, which are, to be blunt, deteriorating rapidly. It's the violent reaction to financial engineering. Let's get right into the most recent data because that's what matters. The company just reported its third quarter 2025 results a few days ago, and they were devastating. Net revenues came in at $70.2 million. That wasn't a gain. That was a decrease of 13.3% year over year. This is a company that is supposed to be in a high growth phase, and its sales are shrinking. The problem is particularly bad right here in the U.S. U.S. retail sales, the burgers and sausages you see in the grocery store, plummeted 18.4%. U.S. food service, sales to restaurants, was even worse, collapsing by 27.3%. The only tiny bright spot was international food service, which grew a meager 2.3%, but that is nowhere near enough to offset the disaster at home. And the losses. The company posted a net loss of $110.7 million. That's not a typo. They lost $110 million on $70 million in revenue. Compare that to the $26.6 million loss in the same quarter last year. What happened? A massive $77.4 million non-cash impairment charge. In simple terms, the company had to admit that its assets, its factories and equipment, are not worth what it thought they were. It's a massive write-down, a corporate way of saying we overestimated our future. Gross margin, which is critical for a food producer, fell to 10.3% from 17.7% a year ago. They are making less on every single product they sell. Now, you might hear the CEO, Ethan Brown, on the earnings call. He said there's plenty of fight left in us and that they're closing out the year with a much improved balance sheet and genuine optimism. This is the expectation he is trying to set, but the reality is found in the guidance. Management said they expect Q4 revenues to be between $60 and $65 million. The market was expecting closer to $70 million. This guidance implies that the sales decline is accelerating into the end of the year. This is the core of the problem. The business is shrinking. This brings us to the recent financial engineering, which is likely the real reason for today's volatility. In October, Beyond Meat executed a desperate exchange offer for its 2027 convertible notes. They had a huge pile of 0% interest debt due, and they couldn't pay it, so they swapped it. But to get note holders to agree, they had to issue over 316 million new shares of common stock, plus new, higher interest 7.00% note. Think about that. The company massively, catastrophically diluted its existing shareholders. The number of shares outstanding exploded, which is why the stock price is at $1, not $10. The CEO calls this an improved balance sheet because it pushed the debt maturity date out. But the reality for equity holders is that they just saw their piece of the pie sliced into microscopic slivers. This is why the stock is so volatile. On one hand, the short sellers, many using sophisticated interactive brokers platforms, see a company with shrinking sales, negative margins, and massive dilution. They see the investigations like the one from Kirby McIntyre LLP looking into whether management misled investors about that massive impairment charge. They're piling on, betting the stock goes to zero. On the other hand, you have a new generation of retail traders, many doing their self-investing on the Robinhood app or using SoFi Invest. They see a stock with a tiny float after the restructuring and massive short interest. They see today's 12% pop as the beginning of a squeeze. They're buying Robinhood fraction shares, hoping to force the shorts to cover. This is a classic Robinhood stock trading setup, a pure gamble. It's a terrible situation for anyone who used this stock as a long-term investment. If you have this sitting in a Fidelity IRAs account or as a part of a Fidelity investment portfolio, it's been a disaster. This isn't the kind of stock that Fidelity Wealth Management would be recommending. It's not a stable holding. It's not something you buy in a Fidelity brokerage account and forget about. Many who bought the dream on their Fidelity mobile app are now facing a 99% loss. This isn't NVIDIA stock printing profits from AI. This is a company that is burning cash at an alarming rate. Analysts at Mizuho just slashed their price target to $1 yesterday, maintaining an underperform rating. They cited the weak Q4 guidance and the simple fact that U.S. demand for actual animal meat is at multi-decade highs. The entire sector has headwinds. The trend for 2025 isn't just plant-based, it's rethinking plants. Consumers are becoming wary of ultra-processed foods with long ingredients lists. That is the exact definition of a Beyond Meat burger. People are moving toward whole food alternatives, not lab-created imitations. And in this inflationary climate, the premium for Beyond Meat products is a killer. When a pound of ground beef is cheaper, the mass market consumer is going to choose the beef. So where does that leave us? What's the future outlook? The expectation from the CEO is a transformation into a global protein company. He's trying to pivot the narrative. The reality is that this company is on life support. The debt restructuring bought them time, maybe a year or two, but it didn't solve the core problem. They are burning cash, and their core market is shrinking. The Q4 guidance proves it. The bullish case, it's not fundamentals. The only bull case is a massive sustained short squeeze that forces the stock into the double digits. This is not an investing sight strategy, it's pure speculation. It's a gamble that the SoFi stocks and Robinhood investment crowd can outlast the institutional shorts. The bearish case is simple: bankruptcy. The company continues to burn cash, fails to find new growth, and eventually the debt load becomes unserviceable again, or they're forced to dilute shareholders into oblivion. This is a story of a great idea and terrible execution, compounded by a changing consumer. For a stock this controversial, I have to ask. Comment below with a simple yes or no. Do you believe Beyond Meat will still be a publicly traded company 2 years from now? To summarize, we're looking at a 12% intraday surge. The market expectation is that this must be a sign of life, a bottom. But the reality is that this is the death rattle of a meme stock. It's the volatility of a company in its potential final act. This rally is fueled by traders on platforms like SoFi and Robinhood, engaging in SoFi active investing, pitted against the institutions using interactive brokers to manage their short positions. The fundamentals are, without question, broken. The Q3 numbers confirm the U.S. core business is in a freefall. The CEO's optimism